Welcome to the September 26, 2018 edition of the BitcoinNews.com Daily Podcast. We cover recent market trends and the biggest stories in Bitcoin, blockchain, and cryptocurrency every single day forever. You can count on us being here. This is your host, Space Marine, live from space. And jumping right into the market analysis. Bitcoin's sitting at $6,500 right now. Bitcoin's been crawling up a little bit today. It was as low as $6,330 yesterday on Bitfinex, and it's been climbing since then for about the past 36 hours and went as high as $6,560. And right now it's about $6,500. But the general trend is upwards for today, and it seems like Bitcoin gets near the support level of $5,800 or so, and then it bounces off it. This has happened like at least 4 times this year, maybe 5 or 6 now. I don't know if it's already bouncing off the support level yet, but the support level is somewhere between $5,800 and $6,500. And that's actually going to be our first story, but we're going to go into the other crypto coins first, the market analysis for them. Ripple's been having a crazy past couple weeks. It was around 27 cents before the rally started. It went as high as 77 cents, I believe. Then it crashed, and now it's going back up. It's up 18% in the past 24 hours. It's at 53 cents, and this is due to Ripple launching XRapid. I don't think they launched it yet, but they're going to. And right now, Ripple's partnered up with a lot of different banks. They always have been in recent years. And they used Xcurrent, where the XRP, which is Ripple's token, wasn't required on Xcurrent. But for XRapid, XRP is going to be required. So maybe a lot of banks are buying up XRP, as well as investors speculating that banks are going to buy up XRP. So that's causing a rally. Other than that, Stellar has been doing good. It's only up 5% today, but it's up to 25 cents. And it's just below EOS. And likewise, Ripple's only $1 billion less than Ethereum's market cap. So Ripple's been trying to overlap Ethereum to take that number 2 spot. And Stellar's been trying to overlap EOS. We'll see what happens. There's a little bit of a mix-up going on in the rankings right now. Or a changing of the rankings, and that happens all the time. The crypto ranks on CoinMarketCap don't stay the same, and whenever there's a rally or a crash, things tend to change. So right now, the general trend has actually been a rally for the alternative cryptocurrencies, and Bitcoin's still hanging around that support level. So now going into that first story. So Diar, D-I-A-R, and they're a pretty good research periodical for Bitcoin and cryptocurrency and blockchain. They found that 42% of Bitcoins are in wallets with over 200 Bitcoins that have had 0 outgoing transactions since Bitcoin hit its peak in December 2017. What this means essentially is that these 200 Bitcoin wallets, like it's 200 Bitcoins and greater, and that could be considered an investment-sized wallet. So 200 Bitcoins is equal to $1.3 million today at the price of $6,500 per Bitcoin. So that's easily an investment-sized wallet. And people haven't sent any outgoing transactions from these wallets that have 42% of all the Bitcoins. They've just been collecting Bitcoins. 27% of the wallets in question have actually gained Bitcoins, but none of them, of these 42% of all the Bitcoins that are in these wallets, it's over 7 million Bitcoins in these wallets. They haven't sent out a single transaction, so they're holding. It's called HODLED in the Bitcoin world. So they expect Bitcoin's price to go up, and that's locking up a tremendous amount of Bitcoins. And we're talking about this because of the price floor. So this study goes additionally to say that 30% of all the Bitcoins are either lost, and that agrees with some studies that say like 2 million Bitcoins are lost, and also illiquid. Like Satoshi Nakamoto's Bitcoins probably aren't lost. He created it, and if he's alive, and he probably is, he has control of the Bitcoins, but he hasn't moved them since he mined them in the early days in 2009 and 2010. And he has 1 million Bitcoins, and then there's some other millions of Bitcoins apparently. Diar is saying 5.2 million Bitcoins are lost or liquid. That might be an overestimate, but it might be accurate. There's no way to know how many Bitcoins are lost or liquid. But just to get to the point of this story, they're saying like 30% of the Bitcoins just aren't moving, and they're not liquid. They're saying 42% of all the Bitcoins, over 7 million Bitcoins, are in wallets that haven't sent any transactions out. So they're actually trying to collect Bitcoin long-term in those wallets. Like some of those wallets have received Bitcoins into the wallet since the peak in December 2017. But even with this huge bear market for Bitcoin in 2018, they haven't sent any Bitcoins out. And that just leaves 13% of the Bitcoins are highly liquid and used for transactions, because Bitcoin is a currency and it's being used for transactions. So that's about 13% of the Bitcoins. And then 15% of the Bitcoins are in exchange wallets and being actively bought and sold. So that leaves 28% of the Bitcoins that are highly liquid. And then the large majority, like we're talking 72% of Bitcoins just aren't moving at all. And this is where the floor comes in. This is why I brought this up. So there's this price floor of $5,800, the support level basically. And whenever Bitcoin's price crashes down towards that level, the selling gets exhausted, and then it bounces off that level and starts rallying. Basically what's happening here is that level represents the point at which, due to supply and demand, there's just no more Bitcoins to sell, because most of the Bitcoins are being held. If all the Bitcoins were liquid, the price could go down to zero basically, but a lot of the Bitcoins are being held, and then as it approaches that $5,800 level, and usually even before that, sometimes as high as $6,500 is when it bounces off of it. That's just about where there's people aren't willing to sell Bitcoin for lower than that price because there's a limited supply. So basically, this dire study has found the real reason for the price floor, and it's a legitimate scientific technical reason. Most of the Bitcoins are either lost, illiquid, or just being held in investment wallets. And there's not that many Bitcoins to sell. So that's good news. There's a real reason for this price floor. It's not just a magical thing. Now for our next story. The U.S. has spent over $5 million on blockchain espionage in 2018. And so there's a bunch of blockchain analytics firms. Chainalysis is the biggest one. Then there's Elliptic, CipherTrace, ScoreChain, Confirm, Blockchain Intelligence Group, Block, DMG Blockchain Solutions. And all these are developing advanced software to track people on the blockchain, because Bitcoin is actually, it was considered anonymous, but it's actually pseudo-anonymous. Basically, a Bitcoin address doesn't have your identification info on it, but there's a whole record of all the transactions for every Bitcoin address, and every transaction is viewable in the Block Explorer. And these firms, these blockchain analytics firms, find ways to attach identities to addresses, because a lot of times Bitcoin's coming out of exchanges, and they get that info. And there's other ways of tracing identity to addresses. And it's mostly probably from the point where it hits an exchange, and then they can get the name of someone and then trace it through. And so the U.S. government's actually hiring these firms, and they spent $5.7 million so far in 2018. And also, $28.8 million of contracts has been purchased with these blockchain analytics firms, mostly from financial institutions and banks, because they have to make sure they're following their Know Your Customer laws and their anti-money laundering policies. So banks and financial institutions buy this blockchain analytics just to make sure they're following the rules, that no criminals are using them, basically. And then the United States government's using it for specific purposes. The Internal Revenue Service, the IRS, which is the tax authority in the United States, is spending the most out of any U.S. government agency. They're spending $2.19 million so far in 2018. And they're probably doing this to catch people that aren't paying their taxes for cryptocurrency. So they're using the most advanced blockchain analytics firms and giving them millions of dollars to try to catch the people that aren't paying their crypto taxes. It's kind of, I don't know what the word is, maybe ironic, because the U.S. Congress just sent a letter to the IRS demanding that they make the crypto tax code clearer. Because right now the crypto tax code is confusing, and then if people were to follow it, it's arduous. You got to list every transaction for cryptocurrency in your taxes, like every transaction for the whole year. Because it kind of is like a capital gains, like you're selling stocks, even though it's being used as a currency, really. And the tax is extremely high. But besides that, it's just it would be like impossible to do your taxes with crypto the way they have it set up. So the Congress is saying, hey, please fix this so people can start paying their taxes. But then the IRS is actually just spending millions of dollars to catch people that aren't paying the taxes because they made it so impossible to pay the taxes. So go figure. Classic government action here. And then the second biggest government spender is the Immigration and Customs Enforcement, ICE. And some people are like, oh, why is the ICE spending so much? Because people usually think of the ICE as like tracking down immigrants at the border, but they actually are in charge of customs, and a lot of packages get seized at customs. And sometimes these are associated with the dark web because people are sending like drugs and weapons and other illegal things with the dark web, and then there's a crypto transaction associated with it, so maybe the ICE is trying to track down the crypto transactions to put names on these packages to get the criminals. Additionally, the ICE is in charge of tracking down terrorists. So the government has a strong belief that terrorists use cryptocurrency a lot. That's not really been proven to be true, but the ICE is probably spending like $1 million to really track down those terrorists using Bitcoin. The next one is the Federal Bureau of Investigations. This one's obvious. The FBI, they spend $1.14 million so far in 2018 on blockchain analytics. And they're probably just trying to track crypto activity related to suspected criminals on like their wanted lists, and also crime organizations like cartels and mafias, and I'm sure that's going on. And likewise, the Drug Enforcement Agency is spending $0.22 million likely to track down drug-related activity such as dark nets and also criminals and mafias and cartels and all that. So that's obvious stuff. But actually, if blockchain analytics are properly developed and really firm, they can be used as proof in a court of law for criminal prosecution. And then the next couple ones are more regulatory. The Securities and Exchange Commission is at 6th place, and they spent $0.18 million so far in 2018, $180,000. And they're working hard to crack down on initial coin offerings and also fraudulent crypto-related securities. So, of course, they're going to be doing some tracking of blockchain analytics. And then we have the Commodity Futures Trading Commission at $120,000 to spend in. They're last on the list. And they're probably making sure exchanges are maintaining proper regulatory compliance because exchanges that trade Bitcoin are actually governed under commodity laws. Just to summarize what's going on here, basically, blockchain analytics firms have found really advanced methods of tracking people through the public blockchains like Bitcoin. Of course, Monero and Zcash are probably still impervious to this for the most part, but Bitcoin is quite traceable, and now there's really good technology to trace people, and now the government's spending millions of dollars to enhance this technology. I'm sure this technology is only getting stronger now that the government's directly involved and spending millions of dollars. Now for our next story. A 2.26 megabyte Bitcoin block was mined on September 5th, 2018. And this is the largest Bitcoin block in history so far. It's the record. And this was made possible by a combination of segregated witness, SegWit, and transaction batching. Basically what's going on here is in August 2017, SegWit was implemented. And before that, the Bitcoin block size had a hard cap of 1 megabyte, and people were concerned that Bitcoin adoption was rapidly going up in 2017 in usage at least. And people were concerned there's not going to be enough space in the blocks for transactions, and therefore transaction fees were going to rise, and that's going to ruin the economy for Bitcoin. So that SegWit was like a soft fork way of increasing block size. Basically what they did is they separated the signature data, which is called the witness, from the Merkle tree of the transaction, and they added it at the end. And then the signature data only counts as 1/4 of a unit. The main thing that SegWit did is instead of being denominated in bytes, blocks were denominated in terms of units. And signature data only counts as 1/4 of a unit. And like 1 byte of signature data is 1/4 of a unit. Therefore, the maximum possible block size went from 1 megabyte to 4 megabytes. It would be 4 megabytes if the entire block was signature data. That doesn't happen because most of the block space is taken up by actually transaction data from the Merkle tree. However, there's been some blocks over 2 megabytes. It's quite rare. The first one occurred on January 20th, 2018, and that weighed in at 2.17 megabytes. And now we have this 2.26 megabyte block, which is the heavyweight for Bitcoin. And it's weird. When you look at the transaction counts, there was 230 transactions in this block. And compare that to an average block that has a block size of 0.804 megabytes, and it has over 1,600 transactions on average. So something odd is going on here. And then you look at the other big block, 2.17 megabyte block in January 20th. It only had 225 transactions. This is because of transaction batching. Basically, you could take multiple outputs or multiple inputs, and instead of sending it in different transactions, you put it all together into one transaction. You kind of compress it, and it saves a lot of space, actually. So that's a great way to scale Bitcoin by batching transactions. If you're going to send a bunch of transactions, like 100 of them, like crypto exchanges use this all the time. They send like 100 transactions, but they batch it all into one transaction. That saves a lot of data, and therefore it saves them on fees. And the record for a batch transaction is 13,107 outputs. So someone sent 13,107 transactions, and one transaction saved a lot of fees and a lot of data, but the transaction size for the single transaction of the batch transaction could be quite large. In May 2018, I wrote an article way back then. Only 12% of Bitcoin transactions are batched. I bet it went up, but they actually accounted for 30 to 70% of Bitcoin volume. So 12% were batched in May 2018, but it accounted for 30 to 70% of Bitcoin volume. So a lot of the Bitcoin volume is going through these batch transactions because exchanges favor them. And then I looked through the transaction records on the blockchain for this 2.26 record block, 2.26 megabytes. And there was numerous batch transactions. Almost all the transactions out of those 230 were batched. And that's what happened here. These batch transactions actually had tons of transactions. So when you think about it, because batch transactions save space versus sending individual transactions, if you counted the actual outputs or the inputs as single transactions for the batch transactions, then this might actually be like a record amount of transactions in a block because the batching saves space and then the block size was near a record. So this is probably like a record amount of transactions. And this shows how SegWit, segregated witness, combined with batching can be a great Bitcoin scalability solution that's already here, and it can bring scalability to new levels. So that brings some hope for the future. Now for our final story of the day. There was a little fight on Twitter between Free Shodan, who's from Parity Communications, and Vitalik Buterin, who's like the primary co-founder of Ethereum. People call him like the king of Ethereum or something. You can call him anything you want, like king, godfather. He's basically, when people think of the founder of Ethereum, they think of Vitalik Buterin. Well, there's a lot of co-founders. So, Free Shodan said, please stop deploying dApps to Ethereum. We are running at capacity. And then Vitalik Buterin says he disagrees, and he talks about how you can optimize the gas. And you need gas to deploy smart contracts and also for transactions. And he's also saying there's layer 2 solutions, and they've been developing like sharding and all sorts of other layer 2 solutions. Like, for example, with Bitcoin, the Lightning Network's the layer 2 solution to increase transaction scalability. So I looked into this further. Is Ethereum really at capacity? Who's right here? And so first off, the transaction volume peaked out at 1.25 million transactions per day in January 2018. And now it's below 500,000 transactions per day. So basically, transaction volume was more than double in January 2018, but Ethereum didn't stop working. So based on transaction volumes per day, Ethereum seems to have a lot of room to grow. Like, there could be a lot more transactions, but there's better measures than that. Another one is Ethereum block sizes peaked at 34 kilobytes in January 2018. And that's a pretty small block size compared to Bitcoin, but they have like block times of like 15 seconds, I believe. But right now, so it was 34 kilobytes in January 2018, and now it's below 30 kilobytes. And that would indicate there's a lot of space for extra transactions. That's a slightly better measure, but the best measure is the gas price. And like I said, gas is literally, it's like gas for our cards, gas for your smart contracts on Ethereum. That's why they call it gas. And there was a clear gas crunch in January 2018. The price went to as high as 96 GWEI, G-W-E-I. That's what they measured the gas price in. And that probably got prohibitive for dApps. Like, it was spiking all the way up quickly, and that indicated that there was a crunch on the gas, and it probably cost a lot of money to use dApps or deploy new dApps, and that really hurt the ecosystem. But then it went back down, as things tend to do. If something gets overpriced, then people just kind of stop using it, it goes down. And there was a couple of gas price spikes in July 2018, August 2018 to 86 GWEI and 57 GWEI respectively. These were actually probably associated with like the Ponzi scheme dApps. But other than that, since March 2018, besides those couple of spikes in July and August, it's been like 10 to 20 GWEI or less for gas price, and that's pretty low. And that leaves a lot of room for dApps to buy gas and not be prohibited. But here's the thing also. The dApps and Ethereum network itself have not been using less gas. They've been using more than 40 billion gas per day on average since January 2018. So the amount of gas being used is as high as ever and quite steady, but the gas price went down a lot. This indicates gas optimization. Vitalik Buterin talked about this in his Twitter response. He's basically saying if you optimize the way you use gas, then everyone could just use the gas a lot more cheaper and still get the same amount of gas. And that means there's a lot of room for decentralized apps to grow because the optimization's really taken hold here. So there's a lot of room for more gas to be used and more transactions because the gas prices are low and they're staying low right now. And then there's another factor. Decentralized app usage has actually gone down quite a bit. The number of dApp users declined 56% from January 2018 to July 2018. So there's a lot less people using dApps, and overall dApps are using a lot less transactions and such. And that alone, plus the low gas prices, indicates that Ethereum is not at capacity. So we had this one guy saying, stop deploying dApps. But looking into the metrics, it's clear that there's plenty of gas available at low prices, and the dApp usage is declining. So there's not only room for dApps to grow that already exist, there's definitely room for more dApps to be deployed. And Vitalik Buterin said clearly, don't listen to this guy. You can make more dApps and deploy them. And then he said, not only can you optimize the gas, there's layer 2 solutions that already kind of exist, and then there's ones that are going to come out. And basically, there's a lot of room for Ethereum to grow in the future, so that's good news. That's all we have for you today on the September 26, 2018 edition of the BitcoinNews.com Daily Podcast. Go to BitcoinNews.com for the full spectrum of cryptocurrency, blockchain, and Bitcoin news 24/7. If you read BitcoinNews.com, you will be an expert in no time. This is your host, Space Marine, going back to space. Adios, amigos.